Investing in the stock market can be daunting, especially if you're new to the game. And with the overwhelming amount of information, the endless metrics, and the complex financial jargons can make it seem like you need a degree in finance to succeed. But what if I told you that with the right approach, you could identify high probability stocks easily and quickly, even without any prior financial education or experience? And that's where fundamental analysis comes into play. And it's this powerful process. This is the secret weapon of professional investors, and it can be yours too, very easily. Before we dive in, don't forget to ring that bell below and hit subscribe. Would love to hear your comments or how you are finding stocks in today's environment. Also, my proven and highly effective cash flow wealth building system has become extremely popular. If you want to learn, go to johnmacgregor.net/free masterclass. Again, johnmacgregor.net/free masterclass. And in the end, if you want to schedule some time with me or my team to answer any questions, you can do so. And by the way, this is the exact same strategy that thousands of individuals are using to generate thousands of dollars in cash flow every single week or every other week or every month, however they structure their trades. And by the way, this is no secret sauce. This is no secret strategy that I invented. It's well written about. There's podcasts and videos about it. All I did was I took this strategy and I codified it into a simple step-by-step process that anyone could follow. Because what I found is the authors and the coaches and gurus overcomplicate this strategy, and they don't have to. And I think that's why my coaching program has become so popular. And by the way, this is the exact same strategy my 93-year-old father is using today to generate $15,000 to $20,000 a month as a hobby. And he's been doing it for the past 13 years. In fact, in a few weeks, he's going to turn 94. And there's a video of him talking about this on my website. So again, if you want to learn more, johnmacgregor.net/free masterclass. It really is a game changer, folks. All right, so today I want to break down fundamental analysis into what I call the 4 pillars. And these 4 pillars will guide you in making really, frankly, sound investment decisions and help you separate the wheat from the chaff in the stock market. And once you set up your screening tools, this process will literally take you seconds to identify high probability and winning stocks. But here's the thing. Most people, in my experience, 30 years of coaching people, lose money in the market because they don't follow a structured approach. Instead, what they do is they rely on hot stock tips or the latest buzz from social media. And that is always a recipe for disaster. Why? Because these tips are often based on speculation and hype, not on the solid foundations that actually drive a company's performance and its stock price. Professional investors know this, which is why they turn to fundamental analysis. With today's technology and resources, it is not hard at all. Fundamental analysis is what separates the amateurs from the pros. It's like having a roadmap, right? In the middle of a forest. While other people are wandering around aimlessly, you have a clear path to follow. And the best part is, like I said earlier, it's super easy to learn and apply, especially with today's technology. And most people don't realize how simple it can be. With the right tools, you can analyze companies' financial health, growth potentials, and market value in just a few clicks. No more guessing or gambling on what might be the next big thing. You'll have a systematic way to evaluate stocks, ensuring that your investment decisions are based on solid data and proven strategies. Because often amateurs get caught up in the excitement of quick wins and flashy headlines, right? But I'll tell you, this approach rarely pays off in the long run. They chase the latest trends without understanding the underlying value of the companies they're investing in, and this leads to poor decision-making and ultimately big losses. By examining a company's sales, revenue, profitability, and valuation, which I'm going to explain very simply, and other qualitative factors, investors can gain, you can gain a comprehensive understanding of its true potential very easily. And think about it this way. Would you rather bet on a horse because someone told you it's a sure thing? Or would you prefer to analyze the horse's track record, health, training regimen, and all those other things? And that's what fundamental analysis offers, a thorough, data-driven method to assess the true value and potential of stocks. So with that, let's dive in. So this first pillar of fundamental analysis is really about sales and revenue of that company. And this is where we look at the right metrics to see how well a company is growing in terms of its sales and revenue. Are they consistently increasing their top line? Is their growth in sales and revenue sustainable? These are critical questions because a company that's growing its sales and revenue is likely to have a very strong future. So let's break it down in simple terms. Sales and revenue are the lifeblood of any company. Think of it as the fuel that keeps the engine running, right? And if a company is consistently increasing its sales and revenue, it means they're effectively reaching more customers. I mean, it's just common sense. They're expanding their market presence. And most importantly, they're making more money most of the time. This is a strong indicator of a company's health and potential for growth. And with just a few clicks, you can assess this data online through financial websites or the company's own investor relationship page. In fact, I just use Yahoo Finance for a lot of my research, and it's free. Now, sustainability is equally important. A company might spike in sales one quarter, 1 year due to a one-time event, but what you want to see is consistent growth over time. Now, let me make this even easier. Many tools that automatically analyze a company's sales and revenue trends, they do it all the work for you. And these tools can highlight the key metrics and provide visual charts that make it simple to see how the company is performing over the time. And you don't need to be a financial wizard at all to understand these charts. They're designed to be user-friendly and straightforward. All right, so that's pillar one, sales and revenue. Second pillar of fundamental analysis is profitability. And in simple terms, profitability is about looking at a company's earnings, the bottom line. Earnings are the bottom line of a company's financial performance and are the primary driver of stock prices. And when a company is consistently growing its earnings, it's likely to see its stock price rise over time, almost a direct correlation. So let's talk about why earnings are so important. Earnings represent the profit a company makes after all the expenses are deducted from its revenue. This is what's left over at the end of the year. And this profit is what a company can reinvest in its business or pay out dividends or use to buy back shares of its own company. In essence, earnings are a direct indicator of a company's ability to generate wealth for its shareholders. And I want to dive into some key metrics that really help us evaluate profitability. And let me just add this. A company could be growing their revenues and have tremendous sales, but they could be spending a lot of money to do that. And therefore, there's nothing at the end of the day. There's no earnings or profits at the end of the day. So the reason I say that is we can't just look at top line growth of revenue and sales. We got to look at what's coming at the bottom. What's at the end of the day? How much money are they making after all of their expenses? Because a company that's just growing the revenues could be very misleading in terms of the profitability of the company and hence the future potential of that stock. So just some key metrics that I use to evaluate profitability. And again, technology does this all for me. We have earnings per share, or EPS. It's one of the most widely used indicators of a company's profitability. And a higher EPS indicates better profitability. And consistent growth in earnings per share, or EPS, over time is a strong signal of a company's financial health. Then we have profit margins. There are several types of profit margins, but the most important ones are gross margin, operating margin, and then you have net margin. And these margins show how efficiently a company is generating profit at different stages of its income statement. You also have return on equity, or ROE. And this measures how effectively a company is using shareholders' equity to generate profit. And a higher ROE, return on equity, indicates that the company is efficiently generating profits from its equity base. And ROE, which is one of Warren Buffett's favorite indicators, is really kind of the management team's report card. I think that's the best way to explain it. And of course, and then also we have free cash flow. And free cash flow represents the cash a company generates after accounting for capital expenditures. This is how much cash is left over. And it's crucial. It's really a crucial measure because it shows how much cash is available for the company to expand, pay dividends, or reduce debt, right? And strong free cash flow is a sign of robust financial health. And evaluating these metrics is much easier than you might think, as I've said all along in this video. And as I said earlier, once your screening tool is set up, all you need to do is click enter once a week or however you want to do that, to find new stocks that meet your criteria. It's that super simple. So in summary, understanding and evaluating profitability or earnings is crucial for successful investing. It's not just about looking at the current profits, but understanding the company's ability to continue growing those profits in the future. Okay, pillar 3, this is valuation. And this is the third pillar of fundamental analysis. And this is where we ensure that we are buying a stock at the right price. Because you may find an excellent company, strong sales, revenue, profitability, earnings, all those things that we just discussed. But if you overpay for the stock, it can turn a potentially great investment into a poor one. Remember, the goal to investing, right? The number one rule of investing is to buy low and to sell high. And that's where valuation comes in. Because again, we may find a great stock, but we don't want to overpay for it. And that's where these metrics come in. Because valuation helps us avoid this pitfall by providing a systematic way to determine whether a stock is fairly priced, overpriced, or undervalued. And valuation is essentially about answering the question, how much is this stock worth? And this involves really comparing the current market price of the stock to its intrinsic value, which is the true worth of the company based on its fundamentals. And if the market price is lower, if the market price or the stock price is lower than the intrinsic value, the stock would be considered undervalued and just might be a great buy. But if the stock price is higher than the intrinsic value, the stock could typically be deemed overvalued, might be a risky investment. There are other factors to consider as well. And here are some common and popular valuation metrics that the pros use and now that you can use as well. Price to earnings. This is the PE ratio. The PE ratio is probably the most common valuation metric that people use. A lower price to earnings ratio might indicate that the stock is undervalued, while a higher PE or price to earnings ratio might suggest that that stock is overvalued. You got to be very careful. You don't pay too much in price for the earnings of that company. That's what the price to earnings ratio is all about. Then you have price to book ratio. And the price to book ratio compares a company's market value to its book value. And a price to book ratio less than 1, typically the rule of thumb indicates that the stock is undervalued, whereas a ratio above 1 could mean that it's overvalued. Price to sales. The price to sales ratio compares the company's stock price to its revenue per share. Remember, we talked about revenue, and this ratio is really useful for valuing companies that might not yet be profitable, but have strong revenue and sales growth. Applying these valuation techniques might seem daunting at first, but again, I'm telling you, with the right tools, it is super, super simple. All right, fourth pillar, final pillar, fundamental analysis is what I call beyond the numbers. Now, while the quantitative aspects, like we just talked about, sales, revenue, profitability, earnings, valuation, those things, they're crucial, but they don't always tell the full story. To truly understand a company's potential, you need to look at the qualitative factors as well. And this really delves into what the analysts are saying about the company, the news of the company, and the sentiment surrounding it, and other intangible elements that really can impact its performance. Beyond the numbers refers to all those aspects that aren't easily quantified, but can significantly influence a company's success. And this includes management quality, competitive advantages, industry trends, market sentiment, and really the broader economic environment. And one of the first qualitative factors to consider is what the analysts are saying about the company. Because look, these analysts, they're very smart people, highly credentialed. Their job, all they do all day, is to study stocks that they're following and then report back to people like you and me what they think of that company. So I personally lean on the analysts a lot to do my heavy lifting. So I can go immediately to a stock and find out what the analysts think, these very smart people, and tell me where they think that stock is going. Analyst reports and ratings, really, they can provide valuable insight into a company's performance and future potential. Now, do I put all my weight on them? No, but again, they carry a lot of my heavy lifting, and they're bringing new ideas to me all the time. As I said earlier, these professionals spend a lot of time researching companies, talking to management, and analyzing market trends. And their opinion can give you a deeper understanding of the company's strengths and, of course, their weaknesses. And you can find analyst ratings on financial news websites and investment platforms. Go to Yahoo Finance, pull up a stock, and you'll see the analyst recommendations. Scroll down to the right, and you'll see what the analysts think about a particular company. One thing to do is to pay attention to changes in ratings or price targets, as these can indicate really shifts in the sentiment and the potential catalysts for stock price movements. I do like to screen for stocks that have seen their ratings increase by analysts, multiple analyst firms. So if I have 3 or 4 analyst firms that just raise their price target on a particular stock, that's a big signal for me to take a closer look at that stock. The news and market sentiment surrounding a company can also provide important clues. Positive news, such as a new product launch, right? Or strategic partnerships or strong earnings that just came out, really can boost investor confidence and drive that stock price higher. Conversely, negative news like regulatory issues, management scandals, or disappointing financial results really can weigh on that stock price. So stay informed, regularly check financial news sources, and set up alerts for companies you are interested in. Like I said, I use Yahoo Finance and a couple of others, but pretty much everything I use is for free. It's got a lot of information. They all have a lot of information that you can use quickly and easily, plus all the news stories and analysts' opinions as well. Also, when I'm in Yahoo Finance and I have a stock pulled up in there, let's call it Apple, and I'm scrolling through the news, a lot of times I will see articles that say the 3 top growth stocks to buy right now, or 2 stocks that are set to just explode. And I know Apple's going to be one of them because I'm on the Apple page, but there's another one in there that I may not be familiar with that some analyst thinks is going to the moon. And so that's another way that I find new stocks to take a look. So gathering and interpreting qualitative information, again, might seem daunting, but with today's tools and resources, it's easier than ever. No finance degree required. So in summary, the 4th pillar, beyond the numbers, really completes the picture of fundamental analysis. And by looking at the qualitative aspects of a company, you really can gain a deeper understanding of its potential and then make more informed investment decisions. And this holistic approach, combining both quantitative and qualitative analysis, is again what separates the amateurs from the pros. And now, knowing all of this with a little bit of practice, you can be a pro very quickly. So there you have it, folks. The 4 pillars of fundamental analysis: sales and revenue, profitability or earnings, valuation, and beyond the numbers. That's it. And by mastering these pillars, you can transform your approach to the stock market, start identifying winning stocks with ease. Remember, no prior financial education or experience is required. Once you learn the system, anyone can do it, regardless of the background, and you have it for the rest of your life. And you can pass it on to others. So thanks for watching. If you found this video helpful, please like, share, and subscribe. Don't forget to hit the notification bell so you never miss an update. Until next time, happy investing. Aloha. Bye.